Most people think a low PE ratio means it's a good stock. Here's why that's wrong and how a low PE ratio can cost you tens of thousands of dollars. Hi, I'm Ace and I built a 400k plus portfolio in just under 5 years in my early 20s using Warren Buffett's principles and the 18-year cycle. And one of the biggest lessons that I've learned is that cheap numbers don't always mean cheap and good value stocks. And here's why. A low PE ratio can mean two things. It can mean the stock is undervalued, like Lennar trading at a PE ratio around 11 with solid margins and a strong balance sheet. That's true value. But it can also mean that the market expects the whole stock earnings to collapse, like a retail chain or a cyclical business on the downside. That's a classic value trap. The key to using PE ratios is to put PE in context. You need to test the rest of all the metrics, including net margins, ROE, ROA, debt to equity, and free cash flow. Now, a stock with a PE ratio of 8 but negative cash flow and declining revenue is not cheap. It's dangerous. And then lastly, you also layer in the cycle. Late in the 18-year expansion, a low PE cyclical stock can look quite tempting, but they're often the ones that get hit the hardest in the reset. Now, Warren Buffett's wisdom applies here. Price is what you pay, value is what you get. The market can slap a low PE ratio on a business because the value is evaporating. Well, there you have it. Now, I do share the exact stocks that pass my full checklist, including Moat, Math, and Cycle, in every single week in my free newsletter, link in bio. Now, a question. What's one stock you bought in the past because it looked cheap that turned out to be a trap? Comment down below, I'll be reading.